First, identify reliable support, such as with the current upswing point in a gap fill area. Next, a range needs to form with a sharp downswing point at previous highs. The current downswing from a bearish star is a good example. Then as price begins to fall, place a Fibonacci retracement on the full price range from the low of the upswing to the high of the downswing, only focusing on the 100% intervals. So the numbers 0, 1, 2, 3, and 4 are the only levels used. Next, we do the same thing but for the time range of the entire upswing, which we are basing a repeating interval on. The end result is a kind of grid like this, where a Fibonacci circle is placed within this 2 by 2 section, starting from the high of the downswing, going 2 boxes to the right and 2 boxes down. We only focus on the center 0.236 portion of the Fibonacci circle. This creates a setup where, if price falls into the circle, it is likely to rebound back to the top of the established horizontal range, with a much lower chance of continuing below the lowest boundary of the circle, because of those bullish features we discussed earlier with the established support in the context of these intervals of time. The balance of the market is tipped more in favor of buyers than sellers. And while it's not impossible, it would be extremely difficult for sellers to drive down price below the lower boundary of the circle, especially within the specified time range of the repeating interval. And naturally, the top of the range now provides a good target, where the strong bullish move does of course begin to slow down. For more on Fibonacci circles, time zones, and other technical analysis topics, please stay tuned for more and check out the hundreds of instructional videos I've already made.